Welcome, everyone, and thank you for joining us at this early hour. So as Angelia said, this meeting is on the record and will be available on demand for those of you who can't quite get enough. We're going to open the day with a poll question. That poll question is, which subject do you think will define 2021? And our options are geopolitics, sustainability, monetary policy, digital currencies, and technology regulation. While people are thinking through this, Tyler Baig, the chief economist of DBS, Patrick Brenner, the head multi-asset investments Asia for Schroders, Mark Sobel, our US chairman at OMFIF, are joining us today to share their views on all of these topics. Could we please look at the results of the vote? Interesting. So geopolitics is still very much keeping people occupied, as is sustainability, and technology regulations at the same level. So I think this makes for a good, rich conversation today. And without further ado, I'd like to invite Mark Sobel, our US chairman, to share his experiences and his views on the state of things in the US.
Well, thank you. I hope everybody can hear me. I was just going to make some brief opening remarks and address three topics. The first is the U.S. policy outlook after the Georgia elections. We'll probably learn more tomorrow. Senator Biden is going to give a speech on some of his economic plans. I should say President-elect Biden. Regardless, with Democrats controlling the Senate, Biden is now better positioned to advance his agenda for sure. Many of the ambitious aspirations in the party may not be easily attained, though. The Democratic majority in the Senate is razor thin. There are centrist senators in the party, especially from red states. The Democrats lost seats in the House elections. They have a small majority there, and there are many so-called moderate blue dog centrist House representatives. Biden himself is a consensus builder and identified with centrism. And there is the issue if the Democrats pursue conviction and the like in the Senate, based on today's impeachment, that could exacerbate partisanship and somewhat occupy the near-term floor agenda. Biden has strongly backed the $2,000 stimulus checks. The recent fiscal bill that was passed in December provided for 600 of such checks. Ramping up to 2,000 could result in additional spending of about $300 to $435 billion based upon how broadly applied it is. Supplemental unemployment support of $300 is already was passed in December and will continue through March of 2021, but there may be a need for more after that. There is strong support in the U.S. for helping small businesses. Direct support for state and local governments, which employ over 10% of the U.S. labor force, was excluded from the last bill, despite huge budget shortfalls. It remains the idea remains controversial with many Republicans. These levels of government, however, are indirectly supported through fiscal support for income, education, transit, COVID relief, and the like. So on balance, some analysts are now penciling in another fiscal package around $1 trillion. I think Senator Schumer today said it should be 1.3. But 1 trillion is just under 5% of GDP. So such stimulus would substantially boost the US growth rate and help the economy reach its pre-pandemic level this year for sure. Obviously, the impact will depend on how much is saved and what the multipliers are, et cetera, et cetera. So now, apart from the immediate fiscal support needs, Biden's agenda includes support for infrastructure and changes to make the tax system more progressive. So infrastructure has long been supported by both parties, but it hasn't gotten off the ground. Views diverge about what to fund and how to pay for it. As part of the president-elect's Build Back Better plans, He campaigned on a $2 trillion package of accelerated investment with a heavy focus on sustainable infrastructure and clean energy. The chances for infrastructure spending, perhaps later this year as part of a reconciliation package, now appear stronger. Some analysts have reflected on whether such a package could also include key planks from Biden's tax plans. So he wanted to raise $3 trillion in taxes by lifting the corporate tax rate from 21 to 28%, increasing the top marginal rate on households earning over $400,000, and some adjustments to estate taxation. So, you know, as one former official I worked with said, there may now be at least a chance to secure some changes, but the path to doing so also seems very difficult. The Fed has repeatedly called for more fiscal supports. Its wishes are being fulfilled. The Fed is now on hold, and rates will remain so for years. Some regional Fed presidents have begun musing about tapering the Fed's monthly $120 billion in purchases later this year or in 2022, though every other board officials today seem to be wanting to tamp down those debates. The 10-year Treasury yield's already risen well above 1%, given the expected increase in fiscal spending. And with this added Treasury paper hitting the markets, the Fed may in time have to grapple with steepening in the yield curve, let alone that an eventual taper discussion could sow the seeds for another tantrum. I should add, I'm not one who worries about a surge in inflation for the time being. We have a large output gap, rents are down, and inflation expectations have been well anchored. So just briefly, a second topic is the global outlook. Very briefly, many are expecting a strong recovery, especially as a vaccine is now rolling out and there's substantial macroeconomic support in the pipeline. I think that's the right trajectory, especially for the second half. But I think downside risk could temper the 2021 upswing. So I think the baseline might be a bit cheery. The vaccine rollout may proceed much slower than thought. The current COVID wave may hit activity harder than we think. Labor market scarring may be harsh and persistent. Monetary policy's impact is exhausted, even if there is more ammunition. Outside the US, fiscal policy may become more restrictive. We may witness a wave of business and corporate insolvencies. And Chinese growth is seen as strong, but I think the authorities may restrain the overall growth rate because of concerns about leverage. And other emerging markets have far less macroeconomic room for maneuver. The third topic I just wanted to super briefly address was the dollar, because everybody's commenting on it, and in general the tone is bearish, although it certainly was more bearish a week ago than it is now. So I think the bearish view is associated with surging risk appetite, the end of a strong dollar cycle, or a twin deficit crash. Now, while offering views on exchange rates can be a fool's errand, I'm going to be foolish, and I'm going to suggest that the dollar, it may fall in 2021, but that the overly negative view is unwarranted in my view, because I just don't see the arguments holding up. So many point to the Dxi Index, which in 2020 was down 13% from its March highs at end December. And for the year as a whole, it was down around 7%. But the Dxi is roughly 3/4 the euro and currencies associated with the euros. Now, that they account for 1/4 of US trade. The Fed's broad trade-weighted dollar was down around 2.5% in 2020. Now, while risk appetite may pick up with the growth scenario I outlined, America's fiscal support and growth potential are higher than Europe's or Japan's. And even stronger growth frequently supports the dollar. And even in a risk-on environment, there would be bouts of volatility and risk aversion, which may cause flows back to the dollar. Shifts in interest differentials heavily impact exchange rates, but short-term rates are already very compressed, and they're going to remain so. And the ECB and the BOJ will become very accommodative if the dollar starts depreciating. The U.S. can readily finance its current account and fiscal deficits given the size and depth of our capital markets and demand for risk-free assets. I've probably spoken enough, so I leave the floor back to you.
Thank you, Mark. And I have to admit, I was getting quite excited with some of the threads that you were leading me on. I'm sure I'll feel the same way in a minute when Timer takes us through his views on China. So Timer, if you will.
Thank you, Tamara. And Mark, that's a wonderful way to get this webinar going. So thanks for your insights as well. I will touch on a couple of things related to China, simply because it is the largest contributor of growth in the world and was first in, first out of this pandemic. So look, on their policy trajectory for 2021, they will basically lead the world in normalization, even if it is not actual normalization, but certainly guidance toward normalization would come from China long before it comes from the US, EU, Japan, or anybody else. And look at how 2020 ended for China on a both macroeconomic and economic diplomacy high, if you will. On the economic side, from the middle of the summer onward, China's production and export engine started firing, and all through the second half of 2020, it did very, very well. And what was the case in China was that people had been sort of scarred by the pandemic in the first half of the year. So even as the Chinese economy opened up, retail sales took its time to kick in, and domestic demand was subdued through the third quarter. But by the time we got to the fourth quarter of last year, we basically had the only economy in the world where both engines were firing on full steam. So as we now are sitting here in January, we have tailwind of surging domestic demand, from retail sales to travel to hospitality, everything, and at the same time being complemented by surging production and exports. If you just have to look at partner country trade deficits vis-a-vis China to see that all these trade war rhetoric notwithstanding, Chinese exporters actually have gone strength to strength over the last 4 years. And during the pandemic year, we sort of came to the realization that there's a lot of stuff that the world really, really needs at times of need. Chinese make it more and better than anybody else, and therefore we remain beholden to importing all those things from them. So successful pandemic management has led to a revival of domestic demand, and having massive lingering comparative advantage and production know-how has led to a big tailwind coming from the export side. Our nowcasting model is looking at the January-March quarter Chinese year-on-year growth to be something in the range of 11.5%. Of course, this is colored by base effect, but even on a sequential basis, the economy is showing significant upward momentum, notwithstanding questions related to regulation and liquidity and so on. So this is one high that China has, the macroeconomic high. The second high, as I said, that there's this whole economic diplomacy high from RCEP to CAI. China basically notched up a couple of major achievements in getting themselves into trade blocks that will be immensely beneficial to them as well as the trade partners. Consider, for example, RCEP, where Japan does not have a free trade agreement with China, but under the RCEP stipulations certainly gets great market access and converges toward free trade type tariff arrangements vis-a-vis China. In the case of CAI, which is the EU-China investment agreement, China has trade agreements with many, many European countries of varying degrees of intensity and depth. But CAI again, creates this framework where it's not just a question of safeguarding your existing investments in the case of China, EU investments, in the case of EU investments in China. It is also about market access, and at least on paper, this is a very big step forward for China. Now, mind you, between China and Europe, you basically have the largest investment block in the world. Right now, Europe's investment position in China is about $140 billion, and China's investment position in Europe is about $120 billion. So it's extraordinary, the symbiosis between the two countries, independent of trade. Trade is, of course, very intense between the two regions, but in terms of investment also, this massive, and this is, of course, a big plus for China going into 2021. Germany, being the chair of the EU Working Committee on all these things, wanted to make sure that, while before their chairmanship expired. They just wanted to get this thing done, and they did. And also, China has expressed interest in being part of CPTPP, which is something I don't think is on top of President-elect Biden's agenda. Mr. Trump basically has ruined that for multiple years, but it will come back at some point. And the fact that the original TPP under the Obama framework was supposed to be a club without China, and now China is basically trying to be a cheerleader, is itself is interesting and ironic at the same time. Now, I said earlier that China would be the first country in the world, major economy in the world, to sort of start normalizing policy or give forward guidance about policy normalization. And you have already seen that happen, that as far as allowing credit default to take place, China has basically decided that they will not have open-ended forbearance. There will be highly visible, significant spillover related type defaults, whether it is SOEs or private companies, take place through the course of 2021, as it has happened in the second half of 2020. Similarly, while Europe and America is sort of coming to terms with the notion of big tech regulation being an imperative, China has gone for it, as you can see, with the way they're going after Alibaba and others. And also, and this is related to my other issue, which is that China is making major strides toward digitalization of its currency, is that they are the first ones to show that as fintech companies get into the world of currency movement and payments and settlement, that the traditional central banking is somewhat undermined because you sort of start losing control over M1. So as you get broader and broader monetary aggregates, it all gets intermediate at the non-bank fintech level, and the traditional multipliers and the way you track monetary policy gets undermined. And again, PBOC is going to be the first central bank in the world which will create, in my view, is actually in the process of doing that, framework under which digital transactions and so on become more visible to the central bank authorities, and therefore they sort of wrest back the control of monetary policy levers, which in many cases have been somewhat undermined by the proliferation of digital payments and settlements that are taking place beyond the banking system. I'm also sort of in danger of sort of going over my time slot. I see it's 9:21 already. Patrick has been waiting very patiently. So I just want to finish with 2 points, which is that beyond the issue of fintech regulation, ERMB, where China is also sort of, in my view, going to set the agenda in many respects around the world in 2021, is the other issue of green infrastructure. Again, we have been waiting for a long time to see infrastructure investment led by the government take place in the US, and it's not really been forthcoming. Hopefully it does with the incoming administration. In Europe, the Corona bonds that they are going to issue, the pandemic bond and the EU level debt financing certainly will be largely catered towards green infrastructure and green financing. Well, China has no unfinished business there. They're already fully committed, and they're going very heavily on greening of their infrastructure, electricity grid, the e-cars, in all of those things. Again, what's happening at the NEO Geely level is very exciting, and will put the current sort of leaders in e-technology and green technology around the Western world under a lot of competition. So very exciting agenda for China, while the rest of the world is still very much in the thick of dealing with a pandemic. I think, or I dare say, that the Chinese have more or less started to leave that issue behind and are getting into the more substantive issues that determine long-term growth trajectory.
Thank you, Toma. And it's quite interesting with all the scene that's been set around the regulatory environment, the move towards normalization of policy, to think about how this will all play out over the various markets that we cover. Patrick, very glad to have a multi-asset specialist here, because of course it's not just the equities markets, but we need to look at the bond markets as well. Would you like to share your views on the impact all this will have on the asset classes?
Sure. Thanks, Tamara. So I think from our side, I mean, we've covered quite a lot already, but big picture is that while in last year in 2020 was all about liquidity, monetary policy, expected fiscal policy, we believe that now we're going into the second stage. In 2021, we're moving in a stage where we're moving from a liquidity to a recovery phase. So that's really the big trend that we're looking at. So from there, our base case scenario is very similar to Mark, is starting from a stronger growth globally, very clearly, but in an environment which is going to still be supported by very abundant liquidity from central bank on the monetary side, from the government on the fiscal side, and we do expect real yield to remain positive, which at the end of the day should be a very positive environment for risky assets. So think the implication for us in terms of the different asset class, if I start first with equity, it's an environment where we continue to like equity, we continue to be constructive on equity. Yes, definitely equity in isolation are their valuation are not very attractive, but we all have to remember that the market doesn't look at equity valuation in isolation. It always compare it to other asset class. And if you compare equity valuation to fixed income valuation, for example, well, then very clearly it doesn't appear that expensive anymore. And it is clearly also showing that a key driver of the equity performance recently has been driven by interest rate, meaning by the liquidity factor. So I think valuation by itself is clearly not supportive, but it's not a net win because they are still attractive relative to other asset classes. If I look deeper into the equity, again, which part of the market should we own? Again, in 2020, everything was about the big tech, a couple of names, and that was again very much driven by liquidity. We believe that now going into 2021, it's now time to where we're moving into this recovery in this recovery phase. Now you need to start to diversify your equity allocation by adding some pro-cyclicality. For example, going into small cap, by going into emerging market. We're not saying you should completely get out of growth. You should not. We're not saying you should completely sell out your big tech, but you should try to start to diversify your portfolio by adding some cyclicality aspect, because the recovery phase is going to be a key driver as well this year. So we believe that having this barbell of keeping some growth but adding some value in your portfolio is actually a very attractive opportunity in the equity space. So that's about equity, and probably the easy part of in terms of the asset class. I think when it starts to be tricky is when you look at fixed income, because obviously given where the extreme low interest rate environment, where the big question for everyone is where are the opportunity on the fixed income side, and there obviously government bonds give you today zero income. The potential for diversification is very limited. So government don't look very exciting, to say the least. If you look at credits, I mean, we're still constructive in general in credits. They had a very good run in last year, and they're probably still supported by this low interest rate environment, especially in an environment where investors still need income. But we also have to acknowledge that valuation has clearly now normalized back to where we were pre-COVID-19. So there's not much juice left in the credit. You can still get your carry, but in terms of price appreciation, you can't expect too much. So you need to look somewhere else. And then here, going back to what Timo was saying around China, we believe that actually Chinese bonds are a very attractive, very interesting opportunity. Because not only they do provide positive real yield, which is very rare nowadays, but they also potentially offer diversification if we have disappointment on the growth side. And thirdly, they still have some structural tailwinds, given that we continue to see increasing participation of foreign investor into that huge market. So we believe that Chinese bonds are pretty attractive. And if you think about it, it's a bit crazy to think into those terms, but we could even argue that Chinese bonds are probably one of the last market which is not a manipulated market on the fixed income side. Because if you look at U.S. Treasury, JGB, German bonds, all those fixed income markets are heavily manipulated by the central bank. And the thing is that Chinese bond, you've seen interest rate rising last year, which is more or less the only market which has reacted correctly to the recovery in China. So it seems that Chinese bonds interest rates are reacting correct still to the macro environment, which is not the case for other markets. So I think those are really the kind of the opportunity that we see on the fixed income side. If I think in terms of risk, for this year, obviously raising interest rate is on everyone's radar, because not only it can impact negatively the bonds, but it can impact negatively equity valuation, given how much equity has been driven by the liquidity part of the market. A challenge as a multi-asset investor, the challenge that we're facing is that given that we are going now in the recovery phase, we're almost forced along the risk curve. So we're almost forced to go into the more pro-cyclical market. But on the other side, we're lacking diversification. Government bonds doesn't provide diversification. It's hard to find any assets who provide diversification. And in that context, going back to what Mark was saying on the dollar, we actually believe that the dollar is an interesting hedge in the portfolio. I will agree that like the sentiment seems too bearish on the dollar. If we see strong relative growth in the US compared to the rest of the world, we're starting to have now real positive interest rate in the US versus Europe. I mean, all those kind of factors should be actually quite supportive for the dollar. And if the key risk is a raising interest rate in the US, then the dollar should actually appreciate in that environment. So conclusion from our side is remain positive on equity. It's now time to add some pro-cyclical position in your equity with small cap and emerging markets. On the fixed income side, big opportunity we believe is on the Chinese bond side, which provide income and diversification. And finally, we believe that we should keep some long dollar exposure in the portfolio, because this is one of the only way to generate diversification in case we have a drawdown in the market. So I'll stop here, and hopefully we have enough time to interact with our attendee.
Thank you, and I'm grateful for that, because the questions have been coming in, and I would like to remind our audience to put their questions in the chat box that they can see on their screens, if they will. If not, they can email inquiries@omfif.org. But to begin our conversation, perhaps I can start with a question for Mark. So Mark, we talked a little bit about the risks of political polarization at this point in time. If that were to manifest, how likely will the Republicans be to support the Biden program? And what are the measures that you think are most likely to pass in 2021?
Well, guessing what the Congress will do is another fool's errand. That having been said, I expect things might start off a bit more quietly, and we'll see more polarization down the road. I think in terms of the issues I was highlighting, I expect the $2,000 checks to go through. That means going from another $1,400. How broad that will be sliced and diced, I don't know. You know, is it for every member of the family gets it, or those kind of questions? I think that unemployment insurance, they'll try and do more supplemental insurance if it runs out in March. I could imagine more small business support, state and local. There'll be support for education and vaccine and health and etc. State and local, I think there's a decent shot at it. But again, some of the Republicans are arguing, you know, why should they support money for inept state and local governments that are run by Democrats now? Anyway, we'll just, in terms of infrastructure, as I said, I think that's down the road. I think there's a shot at it. I think there may be noise around climate, how much of a climate focus it has. So I think it'll be controversial and not easily secured, but I think that's potentially doable if there's a good focus on that. I don't expect tax changes. I think that in terms, maybe some more, you know, maybe on tax there'll be more child care support and earned income tax credit, those kind of things, but not for the measures I outlined, from the major measures in the Biden plan. And then just another word, I mean, Biden is wants to focus very heavily on climate and environment, quite rightly, but legislation is very hard in the United States, and so what we've seen in recent presidencies is increasing resort to using regulations. And the problem with regulations is they can be undone when the next guy or gal comes to power. But be that as it may, I expect that to be a recurring theme with this presidency.
Thank you, Mark. And we did have another question that actually touches on the conversation we were having while we were waiting for the dial-ins to begin, which is this question around whether the impeachment is going to be a great distractor and distract the Biden administration and Congress or Senate, whichever is relevant, to focus on something other than stimulus programs and the tax policies. Would anyone like to share their view on whether we're likely to see the impeachment detract from the changes that we were hoping to see?
Well, I could just say, I mean, impeachment already happened. So the issue is going to the Senate for conviction. McConnell's made clear he's not bringing the Congress back, the Senate back in session till the 19th, I think. So this is obviously going to happen after the inauguration. And just to say that the heat around this impeachment, it will not be anything as it was in the Ukraine episode earlier last year. So that having been said, I think it can be a distraction. I think there is a great deal of fervor among many House members against this action, and this will inflame them. And I do think it may complicate managing floor time, but hopefully it will not stall President Biden's ability to get things moving.
I can just comment from a market point of view. I mean, I think the markets. It's a bit cynical to say that, but the market doesn't have any moral compass. So I think the market really doesn't care about that. I mean, and that's basically what we've seen so far. I think what the market is interested is obviously, I mean, the market is doing a big assumption right now is that fiscal spending is going to be very much front-loaded, and that tax probably going to be more back-loaded. And I think that's the key assumption that the market is doing. I guess there is a risk into that, and I don't know if Mark has a view on that, if potentially taxes could come earlier than what we think, because ultimately all the fiscal spending we've been talking to, including infrastructures, need to be paid by someone at the end. So I think that's probably what matters more for the market than the impeachment itself.
Thank you, Patrick. And it's interesting because we have seen a few questions coming in now around sort of markets and flows. Perhaps if we move the direction to China, if we could think perhaps, Timer, I don't know, this question was directed for you, and I'm sure everyone else may have a view and are welcome to share it, but Timer, if we begin with you, could you explain possible reasons for the increase in capital outflows from China?
Right. So to those who are paying attention to the chat section, I've already written down a bit of an answer for Rajiv there. And I think it's by Rajiv, that is Rajiv D. Miller. Rajiv, good to have you on the call. Look, so we have third quarter balance of payments up to that point, and China has been running very large overall balance of payments surpluses, but the capital account has been on negative territory for a while, simply because the Chinese are investing a lot. Just as I mentioned earlier, that China's investment position in Europe is $140 billion, and Europe also has a very large investment position in China, 120. But it just kind of tells you that China has been buying up manufacturing know-how and technology companies all over the world. Well, US is not that easy to get into, but elsewhere it is. And it is also investing heavily through the Belt and Road Initiative route. And so outward FDI from China is substantial. Now, on the capital flow side, again, net, China is a big recipient these days, as Patrick pointed out. There's a huge amount of interest among global fund managers to invest in Chinese fixed income instruments. Chinese credit market is very heterogeneous. There is some really, really bad credit out there. There's good credit out there. So it's a trader's dream, if you will, that there's a lot of stuff to pick and choose and be constructive and not so constructive. So therefore, again, there's a lot of interest, especially among American bond fund managers, to play the Chinese bond market. On the equity side also, there's been quite a bit of inflow, regardless of all the sort of negative news we've been hearing about US sort of tightening the screw on Chinese companies. So from a portfolio perspective, China is a net recipient. You do have, as always, some outflow out of China where people are trying to diversify their portfolio, buying up real estate around the world, or as a precaution against political risk, moving some of their money outside. But that is not meaningful in changing the big giant behemoth of Chinese BOP engine. So unless Rajiv is going to follow up with something specific he wants to say, that's basically all I have to say on this issue.
So just to give Timer a chance to answer a question on this topic, there are some analysts who have said, that with all the major inflows from the current account and the capital account side into China, they've noticed a substantial buildup in state-owned commercial bank foreign asset position. And they've argued that perhaps this is stealth intervention by the Chinese because reserves aren't rising. So I was just wondering, since I hear that all the time in the United States, if you had a view on that.
No, I don't. I've heard that too, but I've not been able to sort of be privy of specific data that sort of gives us on the macro level, whether that is, consequential as far as in explaining the RMB's rise in the last few months, or is there some sort of a moral suasion going on the PBOC's part to get non-central bank entities to do the reserve accumulation as opposed to PBOC, and which is, of course, in a way to assuage fears of Treasury, red flags. These are stories. I don't have any hard data to corroborate them.
Thank you. I'm going to direct what I call the trader's question to Patrick. The question, Patrick, was the PBOC and Economic Working Committee have indicated a direction towards normalizing monetary policy. With that in mind, and going back to the call on Chinese yields, how much further does Schroders think that the China 10-year yields can rise?
Yeah, I think it's pretty capped. I don't see interest rates rising too much in China. Fact is, the PBOC has been actually the central bank the least loose. They've been the one, if you look on the relative basis, they've been the least accommodative. They've been actually, to some extent, you could argue, tightening a bit and to some extent to cool down some of the leverage we've been seeing. So they've been, you could argue, almost counter-cyclical. They've been acting in a counter-cyclical way, which is not a bad way, I think. And I'm happy to say that, given that I'm Swiss, and that's the way the Switzerland's used to do it, or at least in the past. So I think we probably reach a point where I'm not saying they've done enough, but they've probably started already. And then if you look in terms of the currency as well, the appreciation of the currency is starting to have an impact in tightening financial condition in China. So I don't think they need to do much more than that. So yeah, we wouldn't be too concerned about the PBOC engineering a sudden increase or a strong increase in interest rate in China. It might go a bit higher, but nothing substantial in our view.
Thank you. And I think these questions tie in to some of the questions we've been receiving on growth. And so I'd like to open this question to whoever wishes to take it. The question is, will inflation be a drag for growth in 2021, as we're looking at a commodity bubble taking shape between the oil and steel prices, rising as they are, but then also putting pressure on project costs and investment scenarios if we think about the move towards infrastructure? Does anyone have a view about whether or not we think there might be, on a global level, a drag on growth because of inflation risk?
Okay, I'll weigh in a little bit. Only if that causes a massive bear steepening of yield curves around the world. And I don't really see that. So with the steepening that we're seeing right now is kind of sort of good kind of reflation steepening story that, instead of pricing in 1% inflation or 1.5% inflation as far as the 5x5 markers of inflation is concerned, or if you see the break-evens, 10-year break-evens, all of those things are basically suggesting that instead of being in a very abnormal world highly susceptible to deflationary risk, we are just trying to become normal. Between that and going into a world of substantial and persistent inflation that creates bear steepening of yield curves and holds back growth is a very, very long journey. And in some ways, we can't even dream of that. All we want to sort of dream about now is just a normal normalization where 10-year is above 1% and 30-year is above 2% and things like that. So the world is still pretty abnormal relative to where it was in January of last year. We are only beginning to normalize, and any sort of marginal inflation we see on commodity prices, oil going from 45 to 60 is normalization, not like harbinger for massive inflation pickup. You got to think about the price level as well. No, the only risk around even like say a normalization trade and a steepening outcome is perhaps emerging market growth. They are, of course, more susceptible to the oil beta, that if there's a sudden rise in oil prices, the BOP gets affected and the exchange rate comes under pressure. And those countries do not have reserve currencies to behave they have to be sort of constrained a lot more than, say, Western economies do. So from that perspective, there is some risk for emerging market growth if we were to have a sudden spurt of inflation on energy, on goods, on perhaps even in services. But I think those are, marginal risks right now.
We did hear from Mark earlier a view that China may potentially constrain growth in order to manage leverage as opposed to inflation. Mark, would you like to expand on that a little bit?
Well, thank you. China is always able to hit its growth targets, but if they pump out a given amount of credit, they can obviously achieve whatever growth they want. Now they do that, and I think the Chinese sustainable growth rate has been on a decline. It was 10% a decade ago. It's been 6% now. I've seen forecasts that it's going to fall to 3 or 4 over the course of this decade. But in trying to hit perhaps too high growth rates, credit is pumped out. It goes to state-owned enterprises and the like. The state-owned sector is less efficient than the private sector. They need to make a transition from investment-led growth to consumerism and services, which is slowly and perhaps too slowly happening. And so what's happening is there's a lot of credit being put out into the economy, into state-owned enterprises. People are also reaching for yield, and you see this in total social financing growth. And so there's a buildup in leverage and financial risks in the economy. People think the Chinese banking system is extraordinarily weak. And the authorities are well aware of this. And so they're going to try and, whenever growth perks up, they try and constrain the leverage until the growth is hurt, and then the authorities say you better put your foot on the accelerator again. So I think that is just a process I perceive in China. Timer may have a different view, Patrick as well. And then if others are going to comment on it, I just want to throw one other footnote out there, which is that China's current account surplus is a surge this year. And I was wondering to what extent anybody's thought about whether Chinese GDP growth will exceed domestic demand growth, even if domestic demand is picking up, such that net exports are positive, and that China's absorbing demand from the rest of the world.
No, I think Mark, that's a great observation, and I think that's an eventuality that we'll have to deal with through the course of 2021, and it has implication for sort of global monetary recalibration and the management of liquidity that is circulating around the world. But yeah, sort of going back to my earlier point that through the pandemic we sort of came to the realization that a lot of things that the world needs in a pandemic year are basically made in China. And therefore, despite the tariffs, despite all the other noise around people sort of being annoyed with China for sort of slipping at the beginning of the pandemic, people were sort of beholden to buying stuff. I mean, I remember reading in the Bob Woodward book, Rage, that how Jared Kushner was instrumental in sort of calling up Chinese counterparts to import PPEs in the battle months of March and April, when the US was really sort of running massive shortages of those products. So yeah, I think that domestic demand improvement and normalization notwithstanding, I think net exports for a change will be a very large contributor to growth in China. Because typically, I mean, the share of trade to GDP, China is nothing compared to ASEAN countries or North Asian countries. They're very, very, I mean, in fact, I think trade GDP ratio between China and the US is not that different. But this year, China is running an increasingly larger surplus, again, notwithstanding the tariffs. And I think, again, the US is also running an increasingly large deficit. I think for the months of July, August, September, October, I think US had every single month exceeded $80 billion in trade deficit. So those are extraordinarily large numbers, and that sort of explains to you the market's impetus towards sort of bidding the dollar down. I really don't see that narrative changing in the first 6 months of this year. You've got a lot of tailwind around that COVID normalization, which again will benefit sort of China's exporters. And therefore, your notion, Mark, that net exports contribution and overall export sector growth being sort of significantly greater than the domestic demand, yeah, I think that's a narrative that we will have with us for a while.
Can I just go back on the inflation question, Tamara? Because I think it's a key one, and it's obviously one which concerns the market. And here I would really agree with Taimur. I think we are seeing a normalization process, and I think it's a welcome normalization process. I mean, it's clearly what central banks are trying to do, and the Fed has been very explicit with their new framework of average inflation targeting. So I think they want to let the economy run a bit hot for a moment, for some time, to rebuild some inflation in the system, and I think that's a necessary factor. Now, I agree as well that I think it's going to be a long process. Ultimately, if fiscal policy is successful, it should have an impact on inflation. I believe that fiscal policy has probably more chance to reinflate the economy than monetary policy, because monetary policy, including QE, we know has been reflating the market, asset prices, but hasn't really been able to reflate the economy. Fiscal policy has the potential to reflate the economy, because if lower income people are getting more money, then this is where you're getting purchasing power, and you've got a secondary impact and so on. So if fiscal policy ultimately is successful along the line, you could see higher inflation. But I think that's not for 2021. That's probably not for 2022 neither. It is probably longer. And on that, I just want to raise everyone's attention. We might see some pickup in inflation in Q1 and Q2, but that's probably going to be mainly related to base effect because of the distortion we've seen during the pandemic. So don't be too afraid if we see inflation rates, nearing with 2 or even above 2% in the US in Q1, Q2, because this is mainly probably going to be base effect. And I would personally question the sustainability of that rebound on the inflation. And yes, there are clearly some pockets of inflation, and we are seeing in it. And I think this morning in Bloomberg, there is an article around shipping costs. The container, which used to cost 2,000, now costs 12,000 from China to Europe. So there is clearly some pocket of inflation, but those are very related to industrials, some specific good production. But if you look at services, which is still the vast majority of the CPI basket, you don't see those kind of pressure. There's still a lot of spare capacity. So I think it's going to take a while before those inflationary pressure build up.
And that's interesting as well, because I think one of the questions we had, we talked a bit about the true impact of some of the actions that have been taken. The question was really around how markets have been performing well, but the real economy is in trouble with the quality of jobs or insolvencies for small businesses, which we've been touching on through this conversation. And the question really was, how can growth be brought back for the real economy? I think in Singapore, Taimur, we've seen a lot of work done to try and support the small businesses. In the US, Mark, you've touched on that a few times. Would anyone like to take that question?
So Tamara, since you brought up Singapore, I'll just start by pointing out that the big takeaway from the 08-09 crisis, and something that the European countries sort of lauded Singapore for doing that, is what kind of countercyclical measures do you take in the depth of a crisis to prevent long-term economic scarring from taking place, where you make sure that if people are out of job for 6 months, 12 months, or whatever, their skills don't become redundant, or they, by being laid off, sort of lose hope and confidence and become part of a discouraged worker pool. And we saw that issue, sort of haunt U.S. policymakers for years after the 08-09 GFC. So I think the big takeaway from that into this crisis was the motivation behind those paycheck protection programs we saw in the US, that what the countries like Singapore and Scandinavians did in 08-09, everybody's trying to do that gives some degree of palliative to the economy to prevent long-term unemployment from taking hold. I still think that the countries, again, like Singapore, which are encouraging companies to hire traineeship, subsidizing those traineeship costs, make sure that a 22-year-old graduate who is unfortunately graduating in 2020 will not be facing this abyss of no job opportunities, but because of the government subsidy, companies like DBS would hire them and keep them for 9-12 months, help them build skills, and then when the economy normalizes, they can become active job seekers or stay in DBS if possible. So I think those sort of micro approaches toward countercyclical policy, in my view, is going to be the norm going forward. And that notion that you cut rates a lot, you do a lot of pump priming and inject liquidity, and that leads to big asset price inflation, and that just makes rich people richer. And the waiter in a restaurant or the clerk at a shoe store, gets no benefit out of that. I think that notion has to be tackled through these sort of micro interventions, where you make sure that the landowners and capital owners don't go and evict people, or big companies don't fire people at the first incentive, that they are given some sort of an incentive to buy some time, have some buffer.
Thank you. Mark, Patrick, did you have views? Patrick?
Yeah, I think, on the question around the dislocation between Main Street and Wall Street, I think, the reality is that the market is always looking ahead, looking forward. So I think obviously that's one aspect, and I think the markets, back in mid-March, April last year, has decided that with all the liquidity which was pumped into the system, we will some kind of have some normalization at some stage. So the market has been looking through, and again, I was talking about the market not having a moral compass, but I think it goes into that direction. While people are losing their jobs in difficult situation, the market is looking through that. The other aspect which has probably increased this dislocation is obviously the fact that the recovery in the market last year has been mainly driven by the liquidity. So as I mentioned, the liquidity has driven up asset price. The fact that interest rates have been kept artificially extremely low even during the recovery, has increased this dislocation between the market and the real economy. Now that we're getting into this recovery phase, and that potentially fiscal policy is going to have more impact than monetary policy, we may start to see some convergence between the real economy and the market. I'm not saying it's going to perfectly converge. I wouldn't expect that, but we might see hopefully the gap to close a bit. But that's a hope, because obviously if the gap continue to increase, we know where, we don't know, but we can see where this is going to lead us at the end, right? The more we're getting those extreme divergence between the market and the real economy, the more dangerous it is from a political and geopolitical point of view. So hopefully with the recovery phase, with fiscal policy, we could be able to close the gap.
Thank you. I'm very conscious that the questions have been coming in and that we're very nearly out of time. There are for some of the questions, what I propose is that we will follow up outside of this hour and ensure that we cover off those questions as deeply as we can. Timer has kindly put some responses in the chat as well. Before we close though, I would like to ask if the three of you have any views you'd like to wrap up the day with.
You've done such a wonderful job covering all the topics that we have nothing left to say.
I'm flattered, but the good news is that OMFIF does. So for the people who have been asking us questions on China, we do have an off-the-record conversation with the PBOC on the 21st of January, which Mark will be attending and interviewing the PBOC at. Members are very welcome to sign up. The link is on our meetings webpage. And if you cannot find that, please do email us and we're happy to assist. For those of you who are interested in infrastructure, we do have an interview and panel coming up with President Jin of the Asia Infrastructure Investment Bank, and that will be in February. Also in February, we do have a session covering Central America. The questions we received focused on Latin America, and we will try and come back on that separately. All of our members are welcome to attend the off-the-record conversations, and for the remainder which are on the record, the public is also welcome to attend. I'd love to thank all three of you for these views. They've been very insightful. Timer, thank you for feeding back your answers as well. I'm sure we'll be following up to ask you for even more views because, you know, the audience loves us. We would like to thank Patrick, Timer, and Mark for their time this morning. Thank you very much, and we hope to have you both, well, not both, all of you back again soon.